That is chapter number 3 of your book. We will discuss in the long-term securities, bonds valuations and stock valuation. So in today's lectures, initially we will discuss about the bond valuation. About bond valuation. Okay. What is bond? First, we need to understand that what is bond. Bond is a written and signed promise to pay a certain sum of money on a certain date. I am repeating it again. A bond is a written and signed promise. What does it mean? Written and signed promise. Written and signed promise to pay certain sum of money. What kind of a promise? To pay money on a particular date. This is known as bond valuation. This is known as bond valuation. We have a different definition of the bonds. Another definition of the bond, that bond is a written and signed promise. Debt investment, keep that in mind, this is a debt investment. That is debt investment, or it's a kind of a loan for the company. It is a debt investment in which an investor loan money to an entity, typically corporate, the government, which borrow funds for the principal of the time at a variable or the fixed interest, known as bond. If we talk about some of its features, so we have different terms just to understand the bonds. Number one is face value. Face value, we normally say it's a par value. This is actual amount written on the bond. Actual value or amount written on the bond. For example, for instance, if you have 100 rupees, okay, and you have seen that there is clearly mentioned on your note that this is 100 rupees. 100 is already mentioned everywhere in your note, on your note. Okay. It's clearly show that either it is 100 rupees, 1,000 rupees, or 500. How you will get? Just to see that what is mentioned over your note. So that kind of 100 or 1,000 written on the note is known as its note face value. So just like a note, the value that is mentioned on the bond is known as its face value, and this is normally known as par value or the actual value. Then we have a maturity. Maturity is the number of years when this bond will be mature, or you can say when this bond will be expired. So before expirations of the bond, like for example, if you are purchasing a bond for 5 years, after 5 years that bond will be mature, you can say, or you can say will be expired. Okay, so that time duration is known as maturity. Then we have a coupon interest rate. We will discuss this later, that what is it mean, coupon interest rate. The amount you would receive on your bonds in terms of your profit or the yield, known as coupon rate. Then we have credit option. Credit options are the firms that basically rating the firms on the basis of their financial health, to see either they have a capability to pay back loan or to pay back the amount on the bonds. Okay, so this is known as credit option. Then we have another that is known as embodied options. Embodied options, it's a kind of a alive bonds. What I said, alive bond. That's mean an issuer, the person who is issued the bond, and borrower can proceed further on the bond. Can proceed further on the bond. In fact, if there is any kind of conflict, they can further sue each other on that particular bond. So this is known as embodied options. If we talk about some of the types of bonds, then we have number one, government bond. Government bond, known as treasury bond. Known as treasury bond. These are the bond which is basically issued by the national government, and you would receive the periodic interest rate and repay its face value. And these are the safest, what I said, safest bonds. Why? Because issued by the government, okay, but with a very much lower interest. With a very much lower interest rate. These are known as the government bond. If we talk about, particularly talk about the Pakistani perspective, so what kind of a government bond issued by the government? So here are Pakistan investment bond, normally known as Pak investment bond. When government needs some kind of money, so they issues these bonds, Pak investment bonds, and then US dollar bond. Then we have a WAPDA bond. There are so many, but I am just writing a few just to understand what kind of bonds governments are issuing in Pakistan. Then we have a Sukuk, it's kind of a Sharia and Islamic bond. Okay. Then we have type number two, that is zero coupon bond. Zero coupon bond. As name suggests that there is no interest. No interest rate. Why? A bond that is already based on a discount, for example, a bond with its actual value is 1,000 rupees. It's a face value, but I am saying it's actual value or face value. For example, a bond that selling in the market, or a bond that has an actual worth of amount is 1,000, but selling in the market, for example, on repeats 800. This is discount. Okay, why I'm saying this is a discount? Because it's selling lesser than its face value, so that's become discount. And if it is selling higher than its face value, then it would be premium. So what I'm saying, that whenever you're going to buy a bond, you will buy it on a discount. Okay, there would be no interest rate, and when you will sell it after its maturity time, you will sell it on its face value. So that's why there is no zero coupon bond. Then the third type we have is Eurobond. Eurobond and foreign bond. Okay. A bond issued by, if we talk about the Eurobond, a bond issued by an international borrower. Keep that in mind. It's always issued by international borrower. international borrower and sold to investors in the country with a currency other than currency in which the bond is denominated. For example, a UK based bond, selling in Pakistan, India, selling in Pakistan or India, but it will be sale in the currency where that bonds belongs to. For example, in dollars. Okay. So what I'm saying, a bond issued by an international borrower and sold to investor in the countries where the currency is other than the currency in which the bond is denominated. Okay. If it is a UK based bond, and for example, if it is trading in Pakistan or the India, it will have a same trading currency as the UK have. Okay. But if we talk about the foreign bond, it's opposite to that. A bond that is issued a corporation or the government is denominated in the investor home currency and sold in the investor home market. For example, if you have a bond, it's a UK based bond, okay, and selling in Pakistan or India, but it will be sale or it will be trade within their specific currencies. So that is the difference between the euro bond and the foreign bond. If we talk about in the perspective of their security, so we have basically we categorize them into two parts: unsecured bond and secured bond. Unsecured bond, normally known as debentures. Debenture. Why I'm saying that it is an unsecured bond? Because of the high risk. There is a high risk involved, and if it is high risk involved, mean there would be high return in shape of high interest. However, on the basis of its high risk, we normally said this is unsecured bond. An unsecured bond issued by the creditworthiness company, and these are convertibles. Normally, these are the convertibles, change in the stock after a few time periods. That's why these are known as unsecured bonds. Then we have a secured bond. Secured bond, we have collateral trust bond, collateral trust bond. These bond issued by those owner who already have some kind of a backup. For example, they have their property, spare amount. In case of a loss, they would pay back to the borrowers. Okay, they would pay back to the borrowers. So that's why, because of their backup plan, so the bond they would issue would be a secured one. And normally, the collateral value generally high, 25 to 30% than bond value. Then we have in secured bond, then we have term bond and secured bond and serial bond. Term bond will be matured on a single date. For example, you have invested in the project, and project offering you let's say 15% return on your investment after 5 years, and if you are investing for 5 years, then you would receive a complete interest rate after the maturity time. You would not receive on a regular basis like after 1 year, then second year. No, you will receive a complete interest rate or a complete coupon at the end of your maturity time or at the end of your time period. This is known as term bond. While on the opposite hand, everything will be matured in its installment. Mature in installments. Okay. After 1 year, you would receive principal plus interest, and then second year up to so on. But this is not actually happening in the term bond. This is only happened in the serial bonds nature. Then we have a convertible and non-convertible. Convertible and non-convertible bond. Convertible, as we already have a discussion that some of your bonds will be converted into stocks after a particular time period, and this is a kind of agreement that you already have in hand, and you would receive in shape of your agreement with the companies that either these bonds are convertible or the not. So if they are a convertible, so that's mean your particular kind of a bonds or stock will be converted for example, if it is written that after 2 years these bonds will be converted into stock, that could be happen. Non-convertible bond will not be converted into any kind of a stock or into any kind of a securities after a particular time. So these are different types of the bond we